$15,000.
You're a human. You want things like food, shelter, and a TV that is a little bigger than your cousin's. Here's the issue, though. There is not enough stuff. Not enough homes, not enough food, and definitely not enough TVs that are a little bit bigger. We refer to that as scarcity. It explains why neither you nor anyone else can have everything. It is also the core issue with economics. Economics would not exist if pizza were endless. However, there isn't. We must now make a decision. Economics is the research on how we make decisions when resources are scarce. What then should we do? We exchange goods. 10 apples are yours. I have 5 bananas. We both desire diversity. Trade takes place. Win-win. Unless you have an allergy. In that scenario, using an EpiPen would still be win-win. How then do we determine who receives what? Let us talk about opportunity cost. Every decision you make entails giving up something else. You can avoid watching cat failures by watching this video. Your opportunity cost is that. I hope it was worthwhile. Well, let us get back to trading. Why do people engage in trade? Due to comparative advantage. It occurs when your proficiency in one area exceeds your proficiency in another. You can still specialize and profit from trade even if you are not as good as everyone else. Yes, that is correct. Even if you are terrible at everything, there are people who are worse than you. Congratulations. You are economically valuable. Being the best is not the goal of trade. Being the least bad at the right thing is the goal. All right. Thus, we have scarcity, comparative advantage, and opportunity cost. Let us shake that in a box. Boom. You have just created a market. A market is an exchange of goods and services between buyers and sellers. It might be Wall Street, a farmer's market, or your cousin using PayPal to sell you Fortnite skins. Incentives are the single factor that drives market activity. Individuals react to rewards. You most likely will not purchase a $100 pizza. You will eat 7 if it costs $1. Reduced costs encourage purchases. Sellers are motivated by higher prices. Supply and demand are produced by this back and forth. Demand is the level of desire for a product at a specific cost. The amount of something that people are willing to produce at a specific price is known as supply. The equilibrium price is where they meet. Everyone who wants to buy finds someone who wants to sell at this enchanted number. Prices decrease as supply increases. Prices rise as demand does. Unless the government intervenes and declares, nope, that is price control. It occurs when you attempt to ignore economics. Usually, it does not work out, but we will talk about that later. What happens now if someone dislikes their position in the market? Perhaps you want pancakes and you make shoes. Go find a job. You make money. All money is as a means of exchange. The whole, I will trade you a goat for some Wi-Fi scenario is avoided. Additionally, money serves as an accounting unit so that we can count objects and a store of value so we can accumulate funds for future purchases of somewhat larger TVs. To put it another way, money is economic lubricant. It keeps the trade's gears turning. After that, we created banks. Banks accept deposits and distribute the funds to third parties. Interest is charged by them. That is what borrowing costs. Where does all of this lead then? Prices and incentives are used by markets to coordinate people. However, they do not give a damn about feelings, fairness, or whether you stubbed your toe this morning. All they do is react to signals. We refer to that as the invisible hand. It is not magical. It is just the silent combination of math, desire, and desperation. Let us move on. Suppose you are craving toast, but not just any toast. Toast with avocado. Someone must cultivate avocados in order to obtain that. The bread is made by someone else. Both are shipped to the cafe by someone else. It is assembled by someone else, and you are charged $14. We refer to this as a supply chain. It is the series of actions that transforms raw materials into completed products and then relocates them. It resembles a Rube Goldberg machine. For breakfast, however, all supply chains begin with capital, labor, and land. The production factors. Natural resources include land, air, wheat, oil, avocados, and lithium. Sort of. Planting, harvesting, driving, selling, and feigning a smile are all examples of labor. Capital is created by humans and used to create other things. Espresso machines, computers, factories, and tractors. When you combine these inputs, an output is produced. How much output now? That relies on output. You can produce more toast per person per hour if your labor and capital are efficient. It is all about productivity. It literally determines whether a nation is wealthy or impoverished. More goods for more people with less effort is what high productivity entails, and still burning it is a sign of low productivity. All right, so all of this is being produced and marketed. How can we quantify it? GDP, or gross domestic product, is what we use. It is the sum of all finished goods and services produced in a nation over the course of a year. Final does not imply intermediate. Only the bread is counted, not the flour. If not, you are counting twice. It is cheating, too. There are three methods for figuring out GDP. One is the production method. Total the value added at every production stage. The second is the income approach. Add up all of your earnings. Earnings, rent, and interest. The third is the expenditure approach. Total all of your expenses. GDP is equal to C plus I plus G plus X minus M, where C stands for consumption or the purchases you make. Investments include companies purchasing machinery or constructing things. G is the amount that the government spends on schools, roads, and military parades. X stands for exports, or goods we sell abroad. M stands for imports, or goods that we purchase from them. GDP is increased by exports. Imports deduct. GDP is based on what is produced locally, not just what is purchased. Do not get overly enthusiastic about GDP, though. Does not take into account unpaid labor, activities on the black market, your level of happiness, or whether the GDP was derived from sales. Some people prefer GDP per capita because it gives toddlers access to weapons. To compare living standards, divide GDP by population. Like a microwave without a door, it is still defective but still functional. What, then, causes GDP to increase? More capital is typically better. Technology, increased worker productivity, and occasionally just more personnel. However, growth is not always beneficial. Technically, it is growth, just not the enjoyable kind, if it results from deforestation or turning every river into a sewage pipe. Additionally, business cycles have an impact on GDP. A boom occurs when the economy expands. A recession occurs when it contracts. And it is a depression if it shrinks significantly over an extended period of time. In addition to being partially natural, these cycles are also impacted by aggregate supply, also known as total output capacity, and aggregate demand, also known as total demand. Prices rise when demand exceeds supply. Inflation is that. Prices rise even if there is a collapse in supply and consumers still desire goods. That is inflation as well, but with suffering now. Welcome to stagflation if both supply and demand collapse. It resembles depression, but with more existential dread and higher costs. How come avocado toast costs $14? There may be a supply shock. Fuel prices increased, fungus appeared in Peru, and there was a drought in Mexico. Stuck in a canal are shipping containers. Perhaps demand increased. Brunch is a favorite among millennials. Instagram adores images. Prices react. Perhaps price discrimination is the only issue. The cafe is aware that you will pay, and inflation could be the cause. All right, let us discuss money. I do not want it. What kind is it? Cash is more than just money. It is any form of payment that consumers accept in exchange for products and services. In the past, money has taken the form of rocks, cows, cow-shaped rocks, gold, paper, numbers on a screen, and, for a short while, NFTs. Trust is what counts. Something is money if enough people think it is. Additionally, money serves as a store of value so you can save for the future and as a unit of account so we can count things. Money ceases to be money when that value vanishes, as in the case of hyperinflation. How much money should there be, then? Excellent question. The economy stalls if there is not enough. Prices rise when there is too much. That is inflation once more, as determined by metrics such as the Consumer Price Index, CPI, a weighted basket of goods like bread, rent, eggs, coffee, and, for some reason, a USB cable. So why not simply print more cash? You are able to. We refer to it as monetary expansion. Here's the issue, though. Demand increases, but supply does not if everyone suddenly has more money while the quantity of goods remains unchanged. Thus, supply and demand lead to price increases. Prices rise when more money is spent on the same goods. Inflation is that. When prices increase so quickly that your wallet catches fire before you even open it, it is known as hyperinflation. For instance, Zimbabwe in 2008. $89.76 billion in inflation annually. That is 897 followed by 20 zeros. They had bills worth $100 trillion. You were still unable to pay for lunch, though. Who then determines the amount of money to print? Central banks. Every nation that has a currency has one. In the United States, the European Central Bank in Europe. Whoever cheats the fastest wins in Monopoly. There are two main functions of central banks. First, manage the money supply. Secondly, establish interest rates. Interest rates are the cost of taking out a loan. Because high rates make borrowing capital more expensive, fewer people and businesses take out loans, which causes the economy to slow down. Low interest rates make borrowing capital more affordable, which boosts investment and spending and heats the economy. We refer to this as monetary policy. Tight monetary policy is equivalent to combating inflation. Increasing growth is equivalent to a loose monetary policy. Additionally, there is quantitative easing, or QE. In order to inject money into the economy, central banks then purchase financial assets from commercial banks, such as government bonds. It is similar to printing money, but with spreadsheets and additional steps. What is the true source of all this money then? In response, primarily from loans. When commercial banks make loans, they generate money. New money for your mortgage. New money for your auto loan. On impulse, you bought a kayak and some new cash. They do not give out actual money from a vault. All they do is enter numbers into your account. We refer to this as fractional reserve banking. A portion of deposits are held in reserve by banks. The remainder were loaned out. It continues to function until everyone simultaneously demands their money back. A bank run, that is. The bank fails if enough people become alarmed. To avoid panic, deposit insurance is in place. It is the FDIC in the United States. Similar arrangements exist in other nations. Okay, let us discuss taxes. Governments enjoy making purchases. Money on schools, roads, military aircraft that cost $80 million and crash during test flights, and occasionally on commemorative coins that nobody requested. However, governments do not market goods. Where do they obtain the funds, then? Taxes. People and businesses are required to pay taxes to the state. You will receive a strongly worded letter and eventually go to jail if you do not pay them. Different types of taxes exist. Income tax is a portion of your salary. Corporate tax is a portion of your business's earnings. VAT and sales tax are deducted from your purchases. A portion of your home is your property tax. A portion of your profitable investment, capital gains tax. Wealth taxes are uncommon, contentious, and challenging to enact. They represent a portion of the lives of the wealthy. Excise tax, a portion of your vices, fuel, sugar, alcohol, and cigarettes. Higher incomes pay a higher percentage due to progressive taxes. Low-income earners are more severely impacted by progressive taxes. No matter who you are, flat taxes do not care. Everybody pays the same amount. This money is used by governments to finance public goods. Clean air, national defense, street lights, welfare programs, unemployment benefits, pensions, healthcare, food assistance, infrastructure, bridges, trains, pipes, potholes, mostly potholes, and debt payments are examples of things that everyone uses but would never choose to pay for. In 30 seconds, more on that. Therefore, governments both collect and spend money. We refer to that as a budget. A budget deficit occurs when spending exceeds revenue. A budget surplus occurs when taxes exceed expenditures. Like a unicorn or a fully funded public, it is. Library. Governments borrow money to make up the shortfall. US bonds are issued with the statement, "Buy this, and we will pay you back later with interest." Congratulations if you have ever purchased a government bond. You gave a government a loan. The national debt is equal to the total cumulative deficits over time. The majority of nations are in debt. The US has more than $34 trillion and counting. Japan's GDP exceeds 260%. Norway is essentially debt-free, but only as a result of an unintentional oil strike. So, is public debt a bad thing? It varies. If debt is utilized for profitable investments, such as infrastructure, it is acceptable. It does not grow more quickly than GDP and remains sustainable. There are low interest rates. If debt is utilized to finance pointless voting, it is bad. It leads to uncontrollably high inflation. Investors become distrustful and either stop lending altogether or demand higher interest rates. Debt interest eventually becomes a separate budget item. To repay money you have already borrowed, you take out another loan. We refer to that as debt servicing. Governments may default or cease paying altogether in dire circumstances, such as Argentina 9 times, Sri Lanka in 2022, and Greece in 2012. However, there are times when governments are forced to act, particularly during a crisis like a war, a worldwide pandemic, or a financial collapse brought on by a false housing bubble. Okay, let us zoom out. Assume you are a citizen of a nation. Your nation is unable to produce everything. It may export coffee and import cars because it is excellent at growing coffee, but terrible at making automobiles. International trade is that. Trade enables nations to specialize. Even if they are worse at everything, they are comparatively better at what they do. We refer to this as comparative advantage. Once more, Brazil has the comparative advantage in coffee if it gives up 1 ton of corn to grow 2 tons of coffee, and Canada gives up 2 tons of corn to grow 2 tons of coffee. Thus, coffee is exported from Brazil. Corn is exported from Canada. They both prevail. That is the reasoning behind free trade. Until someone bans one, only goods are transported across borders in containers, trucks, airplanes, and boats. Trade spreads technology, boosts efficiency, reduces costs, and increases variety. Globalization is that. However, not everyone benefits equally. Certain jobs are outsourced. Certain industries are destroyed. Inequality may increase. We refer to that as structural adjustment. Additionally, most people dislike being adjusted. Thus, governments can get involved at times. To assist local producers in evading the free market, they impose tariffs, import taxes, quotas, quantity restrictions, subsidies, and cash. Embargoes, when the political establishment declares no trade for you. Protectionism shields homegrown businesses, but in the long run, it typically drives up prices and makes everyone poorer. Currency is used for trade. Japan wants yen, not dollars, if it sells cars to the United States. Yen is thus exchanged for dollars. This is the foreign exchange market, or forex. The amount of one currency you receive in exchange for another is indicated by the exchange rate. $1 is worth 150 yen. Cool. 1 million Zimbabwean dollars is equal to $1. Not as cool. Both fixed and floating currencies are possible. Demand and supply determine how floating currencies fluctuate. The majority of major currencies take action. Fixed currencies are held in place by force or willpower and are pegged to something like gold or the US dollar. Interest rates, inflation, trade balances, investor confidence, wars, coups, scandals, and tweets all affect exchange rates. Your exports become less expensive if your currency declines. Trade benefits, but the cost of imports rises. Bad for making purchases. You can purchase more foreign goods if your currency appreciates, but the cost of your exports increases. Negative for regional producers. Thus, nations attempt to control their currencies, sometimes subtly, sometimes overtly. We refer to that as currency manipulation. It has been attributed to China. Others have as well. For the most part, the US just whines about it. Repaying a debt becomes more difficult if a nation borrows money in a foreign currency, such as dollars, and its local currency declines. There is a currency crisis there. Argentina almost always, Thailand in 1997, and Mexico in 1994. Supply chains are also essential to international trade. Until they break, they appear effective. For example, in 2021, a single container ship blocked the Suez Canal, delaying 400 ships, freezing 12% of world trade, and costing the global economy about $10 billion every day. One canal, one boat. One reminder of how brittle globalization is. And chips? No, not the edible variety. Semiconductors produced primarily in East Asia in a small number of highly specialized factories. Due to a shortage of chips, used cars were more costly than new ones in 2020. This disrupts everything and is referred to as a supply shock. Now it is time to encroach on your personal space. When you awaken, you get paid when you go to work. Labor economics is that. Jobs are merely a market in which human labor is the product. Businesses purchase it. Behavioral.